All right, let's go ahead and get started today. Today is Wednesday, February 16th, 8 a.m. section. Before we kind of go over homeworks 2 and 3, I know I mentioned I was going to do a video, but we're going to actually just do it live here in class today. I want to mention Monday's EIC group project presentation. So share my screen. So you will be making a 10-minute presentation on Nokia as a group. So basically you would go to Bloomberg and here they are, Nokia FH equity. And you'll notice that they are in euros, but it doesn't matter for purposes of the EIC. And then again, you'll need to go to RV and make sure you turn in at least the 2 screenshots of the RV markets beta and also of the industry spread. And then the other question is, what source do you use, okay, for peers? Now, I'm not going to answer that today, but I'll just tell you that if you look at the source list, you can get a sense. You can choose the analyst or the BICS, and then you can decide whether or not they're a global company or a local company. That's going to be up to you when you do your assignment, and that will be part of your grade, is to select an appropriate list and make sure that you're analyzing accordingly in terms of what Nokia does. Okay? So let's say I picked GICS or picked as Curate as an example. You'll notice there's a segment versus if I do here, there's a segment, and you'll notice they have 2 businesses. Okay, so I'll give you another hint. In your EIC, if a company's in multiple businesses, then you have to do an EIC for each one of those businesses, right? When it comes to the economic sensitivity, might be different for communication equipment than application software. So you're going to have to talk about that, and you're going to have to show me data on that. Also, you're going to have to show me that the 5 forces might be different because the spreads might be different for communication equipment and for application software. Okay? So when you're doing this, that is going to be important for how you do your presentation. So if you just do the company, you're going to lose points on your presentation because the company is actually in multiple segments, and the segments have different industry structures and different levels of performance. So that is something you're going to have to cover in your presentation. I'm not going to do this for Nokia because that's going to be for a grade next week, right? I'm not going to give you the complete roadmap to this, but I'll give you an example. Let's say you're doing a company like CVS. So you go to CVS, and you'll notice here that it says whole firm, and this would be bad, okay? Because if you just did CVS, you'll notice CVS's peers are in a lot of different industries. So I have to do 3 different segments, right? Managed care, food and drug stores, healthcare, supply chain. So you'll notice when I click on healthcare supply chain, the competitors and peers, which include companies like Cardinal and AmerisourceBergen and McKesson, are different than when I do managed care, which will have businesses like Anthem and Humana and United Health Group and Cigna. Okay, so those are different peer sets for the different segments. You're going to do the same thing with Nokia. So what that means is that if I go to markets and I do beta, I'm going to have a different industry beta for managed care. CVS stays the same, but its peer groups are different versus if I did healthcare and supply, right? And they're going to have completely different levels of sensitivity and economic analysis. Same is going to be true when you go through the industry spread. So if I come here to custom, the spread of healthcare might be different, supply chain might be different than managed care, which could be different than the food and drugstore business, which would be competitors like Walgreens and Rite Aids. So again, that's going to be something you're going to have to do with Nokia, right? So it's not just one size fits all, one company, talk about it all. If they have different types of businesses, you have to talk about each type of businesses in your E&I section, okay? So it's gonna be the 5 forces of the food and drug store business, the 5 forces of the managed care business, 5 forces of the healthcare supply chain business. EIC, here's the economic sensitivity of the healthcare supply. Here's the economic sensitivity of the food and drugs. Here's the economic sensitivity of managed care. Now, you only have 10 minutes to do the presentation, and you're going to be on a timer. So what's going to happen on Monday's class is we're going to start. All the teams have to present, all 6 teams. We'll get 10 minutes. I'll have my iPad out. I'll set 10-minute timer. You'll get started. You'll do the presentation. When it hits 0, you're done. And all the data has to be in that PowerPoint, okay? If it's not in that PowerPoint, I'm not grading it. So if you forget to say something and you realize another team said it, you're like, oh, we should have said this, but it's not in your PowerPoint, you don't get credit for it, okay? So if it's not in the PowerPoint, you don't get credit for it. So what has to be in the PowerPoint? All the screenshots, right? You can't leave the PowerPoint to go get other files somewhere else. And if you don't have any of the screenshots, then you're not going to get full credit. You'll lose points. So what are the screenshots? Well, if they have multiple segments at Nokia, you're going to need multiple segments, screenshots. One for example, the equivalent of managed care, food and drug stores, healthcare supply chain for the businesses that Nokia is in, mixing metaphors here. And same thing with the RV spreads as well as the betas. So if you need to supplement other information, so for example, when we're talking about Exxon, talking about oil prices is going to be critical to the ExxonMobil assignment. So you should put in a screenshot talking about what's happened to oil prices over time and maybe the relation to Exxon. So again, if you're talking about it and you don't have the data, I'm not giving you credit for it. Here's the other thing. I'm only going to grade what's presented. So if you don't get to it and you run out of time, I'm also not going to grade it. So if you get to EI and you run out of time, you don't get to C, I'm not going to give you credit for C, even if it's in your PowerPoint. So you have to manage your time efficiently. So 2 things happen. Number 1, this week, you need to be working with your teams to create that presentation and make sure that you practice. Because when teams kind of go in there and ramble on, they don't practice, everybody does it independently, 2 things tend to happen that hurt your grade. Number 1, you run out of time, okay? Because the I section can go long, right? I'm not saying that you put equal amount to each of the sections, but you got to cover all 3 sections for your grade. And the I sections tend to run long. And so I hate to see your team, who the people that did the I, don't talk to the people who do the E and the C, spend 9 of the minutes on the I, and then you can't even get to the C. It'll kill your team's grade. So manage your time accordingly. The other thing is that even if you are not making the presentation, you can decide who on your team is presenting on behalf of the team. It's going to be a team grade. But if you're not presenting, you still have to be there. And number 2, you have to participate, because there is going to be, after the presentation, a peer review. And if your peers say you didn't participate, you're getting a 0. You're not going to get credit for the presentation that you did not work on, right? So it's a team grade, which means team effort in creating the team presentation. Notice the word team is being repeated intentionally, right? So that is next Monday, right? The other trouble to avoid, mentioned there were 2, is that what'll happen is you guys do these things independently and then you start contradicting each other, right? So be careful about that as well. I will probably chuckle and I'll find it very amusing as I reduce your grade. But basically, the people that do one section start talking about this horrible, terrible industry, and the people in the other section refer to the great industry. And I'm like, are you talking about the same company and looking at the same data? So that's the point. Make sure that you're integrated across your presentation and you don't say dumb things that contradict the person before you, right? Because that will really hurt your grade as well. And I'm not going to grade you just because one person was right. Start contradicting each other, then I have no way of knowing which conflicting data is right. You're going to lose a whole lot of points. Right. All presentations in PowerPoint must be submitted by 7:15 Monday morning. If the presentation is not there, I'm going to give you a 0 for the group grade. Okay, so make sure that somebody submits on behalf of your group and don't all be pointing fingers saying, oh, I thought that somebody else was going to submit. No, you were going to submit. No, you were going to submit. Make sure somebody takes accountability for submitting on behalf of your team. It's one submission on behalf of the other team, but the PowerPoint's not there. You got nothing to present. All right. And so therefore you won't get a grade. right? So I'm just going to be clear that these are going to be the rules for all 4 presentations that you're going to have to do this semester. And I will pause here because hopefully that's clear, but let me know if there's any questions. Somebody asked in the chat, is it okay if I choose Nokia US equity? Absolutely. You can choose whatever you want. You might not get credit for the grade, but you can choose whatever company you want. But an ADR is not the company. Nokia is not a US company. They're based in Finland. That's why I specifically mentioned Helsinki in the instructions. And when I showed you in Bloomberg a second ago, I showed you that you're using the actual stock. You're not using the ADR, but you can use the ADR. You can make screenshots, but you just won't get any credit for the assignment. Other questions?
I had a question, Professor.
Yep.
So just to clarify, we're focusing on the telco supplier industry, is that correct?
You're focusing on Nokia, and I gave you a hint that there's 2 industries that they are in. You have to cover both.
Okay, I was just asking that because of like the announcement. It said like it mentioned specifically the telco supplier industry, but okay, thank you.
I'm being very clear that when you look at Nokia and you notice in the comm source, they have different types of telco supply.
Oh, okay, thank you.
As a matter of fact, I'll give you another hint. If you want to start to see, and we'll do this with, so we'll start with ExxonMobil. Let's talk about homework 2. So let's say you're doing your ExxonMobil assignment. Okay. So first thing is when I go to RV, now I didn't ask you to do this for homework 2, right? But if you had switched here to BIC's best fit algorithm, you'll notice that if you look at ExxonMobil, it says whole firm, you'll see that Exxon's actually in 4 businesses, right? They're a global oil company, but they do a lot of different things. So they're refining and marketing, okay, which is where they process oil to gasoline, is FARD and sell it to you. So this is the ExxonMobil gas stations as well, is different than the people who do exploration, right? Which is different than the chemical side, because when they process oil, they don't just make gasoline, they also make other petrochemicals, plastics, etc. And so the point is they actually have 3 segments. And then this one is the integrated segment, which is somebody who does everything. Okay. Matter of fact, in the business, they call it upstream, downstream. Upstream being basically where you take the oil and get it out of the ground and ship it around, and downstream, which is process it and get it to the consumer. So there's different ways to kind of slice and dice this industry. But if you were actually doing Exxon, you'd have to do these 3 segments, right? Now, I didn't ask you to do that in homework 2. You were just on your training wheels and getting started with the assignment, but you probably would have gotten a hint for this if you had gone to IBIS World. Because when you went to IBIS World, and you started searching for, where's Exxon? Search up there. What you'd have quickly noticed is that Exxon's in a lot of different reports. Okay, they're in a mining report, they're in an oil drilling report, they're in a manufacturing, petroleum refining, motor oil, petroleum refining in Texas, oil drilling, gas extraction, just to name a few. But if you looked at a few more, you'd have also noticed oil and gas in the US, extraction, etc., global oil and gas production. So what you quickly start to realize, even if you started going through IBIS World, is that Exxon's not just in one industry. They're in a lot of different businesses as a global conglomerate. So it's not a one size fits all model. The 5 forces are going to be different in each of the segments. And the returns are going to be in different parts of the segments. And sometimes the refining business makes a lot of money and sometimes it doesn't. Sometimes the extraction makes a lot of money, sometimes it doesn't. And so you'd have to talk about the different perspectives of each of the industries. Now, because you guys were on training wheels, and I didn't explain to you this before, for your purposes, your grade, I'm not going to hold you accountable for homework 2 for that. But I'm explaining to you as you go through Nokia, Nokia is in more than one business. And you must talk about the 2 businesses at a minimum that they are in. And the industry segments and the competitors and the performance and the structures are different. And what happens to them in the future is different, because that's the whole idea, is that when we evaluate a company, you got to evaluate the company. And if the segments have different levels of profitability and different levels of growth and different levels of performance over time, then when we value them, we can't value it as a one size fits all, right? And that's just going to be very important to understanding values of companies. So that's going to be where we're going to start with EIC, all right? So again, for the first homework 2 and homework 3, I'm not holding you accountable for doing that. I needed to at least start the process for doing EIC. But now that you guys have been doing a couple assignments and had a couple weeks, you're going to start getting more advanced. And so for Nokia, you need to do it in a more formalized manner. Okay, and that's Monday. Okay. All right. Any other questions? All right. So let's go back. And again, we'll start talking about the minimums. So for ExxonMobil, really, you should have talked about a minimum of 3 things. But let's start with the first one, which is you should have gone to markets. And I think I told you use analyst curated. Markets, beta. And I told you use the North American oil supply. So there's only 5 companies on this list. As I said, simplified the assignment. It's got 5 big US oil companies. We use raw beta 1.26. And so obviously this would have been relatively easy to say, this is a pretty sensitive industry. They're 26% more sensitive in both directions at a 1.26 beta than the S&P 500. And Exxon is a little less sensitive, the industry average at 1.07, but they're still pretty sensitive. And so what the whole point is, these companies are very much tied to the economy and to some degree oil prices. But look what's happening right now. We are seeing in the US economy a lot of inflation, right? And it's driving up prices, but it's also because there's strong consumer spending and strong consumer demand. Well, if there's a lot of demand, next thing we're doing is we're using more oil. And because we're using more oil, this industry is very much tied to supply and demand, and the prices are rising. So again, in a strong economy, people use more oil, prices tend to go up because the supply is constrained and demand goes up. More demand, same supply, basically higher prices. And that's what's actually happening in the real world today. And that's also why this industry goes through boom and bust cycles. Because same thing, when the pandemic, everybody stopped spending money, everybody stayed home. Basically, demand for fuel went way down. That's why prices plummeted. As we saw when we looked at our price of oil map, we can just quickly remind ourselves, price of oil. And so if I made reference to this, I would have taken a screenshot of this and put this in my PowerPoint. But if I GP this and go back 5 years, this is why we said oil prices not only plummeted, they went negative for a week, but this was terrible economy, prices go down, economy starts to boom, prices have been heading straight up ever since. So boom and bust cycles. In fact, I think you'd refer to that in your 5 forces, that's actually what's going on in the industry. It really comes down to supply and demand. In fact, if you go in a longer play, last time oil prices spiked above 100, they actually started to come down, right? And part of this was that OPEC was getting strong, and essentially what started to happen is in the late 2000s, the US actually started booming with oil production by essentially inventing the fracking industry. And fracking started to become very important because the US actually started getting to the point where we were producing I think we're the 2nd largest producer of oil in the world at this point. And that was upsetting OPEC because we were taking their market share. And Saudi Arabia, in order to maintain prices as the biggest member of OPEC, was continuing to cede market share to countries like the US and Russia, which were increasing their production. And so to maintain prices, what the Saudis did is they cut back on their production. Well, at some point, they're like, all right, this is too much. We're losing too much market share. So they said, if you guys don't actually kind of get with OPEC, and the US fracking companies couldn't by law, then we're going to flood the market with oil and wipe you out. And that's actually what happened right here. This is the Saudis flooding the market with oil during that recessionary time, trying to wipe out the frackers. And what ended up happening is the frackers did start to cut back on their production. Oil prices plummeted. because Saudi Arabia had flooded the market. And as Saudis pulled it back, unfortunately, the frackers started increasing their production again. So what they didn't realize is that the US actually had a competitive advantage with fracking because it was much lower cost and it didn't have the fixed cost of the original oil and gas drilling. So had some negative consequences, externalities, like earthquakes and damage to the environment, but we don't care about that, particularly in the Midwest. But in any event, so as the frackers, the Saudis realized that the frackers were here to stay long term, then oil prices kind of came down and essentially stayed low and plummeted during the last recession of COVID. And now that the economic times are strong, oil is starting to rise again. And that's the point. We'll go through a boom cycle and then we'll go through a bust cycle. That's been the history of the oil industry, which is it goes back to supply and demand, which is why we say ExxonMobil, for example, if I add EXOM and share price, you'll notice that their share price is probably the other way around. It's an easier way to see it just because of the scale of this. So if I go to Exxon first, then you can see the quarterly 5 years, probably a better way to see it. Exxon, and then I'll add price of oil. It's particularly in the last 5 years, they're pretty correlated to the price of oil. And that's going to be one of the key points to the industry average, which is why I would take a screenshot of this and submit that as part of my PowerPoint if I were doing a presentation or a paper. All right. So next, we would be talking about the I in the industry. And so in the I, we would have gone to RV, custom, and spread. Again, I took out the concept of spread because many of you didn't create the custom formula. So this is probably what you would have submitted. But the whole point is negative spread, right? Very negative spread for an industry ROIC of 1.38 against a WACC of 9.75 today. ExxonMobil with a negative 3.78% ROIC against a WACC of 8.47. So basically, this is an industry that is destroying value and Exxon destroying value at a bigger rate. So they also lack competitive advantage, which will be key to our C part of our conversation, right? And so here's the other thing versus what we had talked in class when we looked at the global market, which includes countries that basically own their oil companies. It's a different story than when you look at market-based oil companies in the US, which are not owned by the government and still compete globally, but don't make nearly as much money, right? So there is basically an advantage to the company-owned, it looks like long-term, the government-owned oils that tend to give a higher, that are part of OPEC, that are getting higher returns than the more competitive ones right now. But that's not something you had to necessarily talk about in your paper because you were just analyzing the data that you saw, which is the ROIC spread in this industry. So here's the idea. You have to start out in your I and you have to explain what you see. Why is this industry, not Exxon, but why is this industry of these companies having a negative spread, 9.74 minus, 1.38 minus 9.74, right? And so that's where you could have done two things. One, and I'll give you another screen to look at. You could have started to go to SPLC. What you know from your Bloomberg training in BMC is the supply chain. Because what this screen will show you is these are Exxon's major suppliers on the left, and these are Exxon's major customers on the right. Okay, and so these are competitors down here. So basically, you can see one of Exxon's biggest supplier is a company called Fluor, right? They represent 4% of Exxon's CapEx and 5.82% of Fluor's business is Exxon, right? And so that's the point. They use this major international construction company to basically help them build refineries, build plants, drill oil, right? Same thing. Schlumberger, another big player and supplier to production of oil, right? Versus they got some other companies here that are supplying them as well. And so the whole idea is if you're starting to understand like who are the big suppliers and understand the power of the supply, first thing you'll notice is that there's not one supplier that represents a very big percentage of ExxonMobil's business. And I'm not saying there's not some critical suppliers in here to Exxon, but when we start thinking of power supply, this would inform us. So for example, I had one supplier is like 30% of my business. So for example, if I am SWK, Stanley Black & Decker, you'll notice that for Stanley Black & Decker, 15% of their sales go through Lowe's, 12% of their sales go through Home Depot. Those two companies, Lowe's and Home Depot, represent 27% of their sales. Now, they're 27% of Stanley Black & Decker sales, but they're only 3.8% and 2.1% of Home Depot and Lowe's sales. So Stanley Black & Decker has a lot more on the line when Lowe's and Home Depot do something to them than Lowe's and Home Depot could drop them. And yeah, it'd be a little painful for them, but it's not a big chunk of their sales. So when we start thinking about who has the power in that relationship, if you're talking about Stanley Black & Decker, almost all the power is right here. It's with their customers. And their customers are not you and me, because we don't directly buy tools from Stanley Black & Decker, right? We want to buy their drills, their DeWalt drills, or their hammers. We're buying them mostly from Lowe's and Home Depot, right? And so that's the point. A lot of their sales are concentrated through these two companies. They have a lot of power over Stanley Black & Decker. So when you start doing buyer power, that's going to be important to your analysis, right? Now, in the case of ExxonMobil, here, right? We can see again who they're selling to, and you start looking at this list. You know, one of the things you start to see on this list is airlines. Airlines are very important to oil companies because, like I mentioned before, 20 to 25% of an airline is fuel. So they could be some big companies, suppliers, and you can see some others. They're going through this list. But the point is, when you look at the revenue, their biggest customer was only 1% of revenue. And that was actually something referenced in the Five Forces IBIS World article, which is that you don't have gigantic customers for the oil companies. And there's a lot of customers. And so they don't really have a concentration of power. And that doesn't give the buyers a lot of power over ExxonMobil because there's not just one big buyer like there is with Stanley Black & Decker that's going to be important to ExxonMobil, right? Since they're selling globally to a lot of different players. So that's the other thing you can start to see as you go through the business, but that's also something you would have picked up in multiple areas. But this is just something you can start checking out as well, SPLC, right? So again,
could you go over how to get to that page again?
So just go to a company, I'm ExxonMobil, and it's called SPLC, stands for supply chain. It's one of the things covered in your BMC training. So that would be this chart. And the colors represent earnings surprises. So their last earnings report, if they had a negative surprise, red, and their last earnings report, positive surprise, green. So you can also start to see, okay, all of my customers are having positive earnings surprises. Some of my suppliers have big negative earnings surprises. And you can start to think about how that might affect the company itself. Same thing, you can also change some different colorings on what's happening with these other supplier boxes. Very cool screen in terms of being able to get some information about companies. Bloomberg sources this from both public data and proprietary sources. So going back to Exxon, now you're doing your Five Forces. I had to explain the negative spread of the industry. So I mentioned a couple things you needed to do. One, stop, share screen. So one thing you would have done is you'd have downloaded one of the reports. And to me, if I had to pick one, I would have picked the global oil and gas exploration because Exxon is a global company. But basically, many of those will talk about the same thing. Or like right here in the report, they give you a lot of what's going on with the Five Forces. That was a big hint that I had talked to you about. And as I said, as long as you're sourcing appropriately, you can use this information. But it's right here is the first part, right? And that's the point, like industry structure. They're already doing that, a lot of the analysis, right? So back to the point, positive impact, low concentration. All right. That's the whole idea of what we were just talking about, that there's not a big concentration of customers, right? And so since there's a lot of customers and there's not a few big customers, that doesn't tend to give the buyers a lot of power in this industry. The barriers to entry are extraordinarily high in the global oil and gas company. Huge capital investments are required to get in this industry and lots of regulation, believe it or not. So that tends to make it difficult for somebody to just jump in and become big oil and gas supplier. That helps the industry over time. All right. So the other thing is that technology change is not happening at a rapid rate. This is not an IT-based industry, although technology is starting to affect the industry. And it's affecting in two different ways. But one is the industry itself and production of oil. But the big one is now we're starting to see as a substitute, as we start to see the growth of electric vehicles. And that is going to be a challenge to the oil industry, probably more longer term than it is today. So that's the point. We start thinking about power substitutes. Today, not as strong. Tomorrow, probably growing. And so the question is, in 5 years or so, how much is it going to grow? That would have been part of what you talked about in your paper, right? And then the other couple things that you would have talked about was high levels of capital intensity, which drive essentially further barriers to entry. But when it comes down to competition, that's the point. The problem with rivalry is dependent for this industry on supply and demand, right? And that's what I was trying to show you with the price of oil. Basically, when we see supply constrained in the oil industry, prices spike. That's what's happening right now. We got a lot of demand. We don't have an increase in supply. Prices are going up, right? Because of the booming economy. But they talk about it even in this report. There are booming and bust cycles that this industry goes through, because this industry is not going to have high prices forever, because at some point we're going to have a recession or some other event, which is going to basically cut back on consumer demand, or you're going to see the growth of electric vehicles cutting back on the demand, which in the net is going to take away demand relative to supply. And that is going to cause prices to start to come down. So in a way, this industry is going to go through boom and bust cycles. And so the question right now is, as you look at the RV, what's the industry spread today? To some degree, I know it's really hard to differentiate because oil prices, if you go to the pump right now, look really high. But over the course of most of 2021, which is the data that you're actually looking at in your ROIC, oil prices were closer to 50 than 90. And so when oil prices were back at 50, the oil industry wasn't doing that well. You saw that with ExxonMobil's stock price, right? Basically, their share price started doing well. And to some degree, the performance of the ROIC will be better now that oil prices are 90 versus back when they were 50. But that's the point. You're explaining last year in the current five forces, and the five forces at the time said there was a lot of supply relative to demand, and that gave the rivalry more intensity, which is one of the big reasons why the industry had lower returns last year. Now, where you think it's going to go in the market for 5 years from now, that's your choice, right? Because you are making an impact forecast about whether or not this industry is going to get better or worse in the next 5 years, and you can make either case, right? But that's the point. You had to make case. You had to support it with data. Obviously, you could have gone through the BICO and the BRC, just giving you some sense at a minimum level of the things to be talking about. But that's what you would have been talking about for the I for ExxonMobil. So for example, if you had said that, basically in the next 5 years, we're seeing positive economic cycle, that will lead to less rivalry because of the intensity. We don't think that the EV market is going to be growing that much in the next 5 years to truly challenge the oil and gas industry. You can talk about, political stability in the world. It won't be harder to do, but there could be, which also may not impact higher oil prices. Again, we don't really have a change in what's happening with the buyer power because we're not seeing any big concentration of buyers. Same thing with the suppliers, there's not big concentrations. So nothing's really changing about those power dynamics. So that tends to be favorable to the oil and gas industry over the next 5 years. You could also say that we're going to be heading at, because of these high inflation times, for high interest rates. And that's going to cause, to some degree, a US recession, probably in the next year or so. and that's going to send oil prices plummeting again, which is actually going to lead to a period of sustained low growth, therefore poor performance for the oil companies tied to a worsening economy. And that's going to lead to an increase in rivalry, which could lead to poorer performance and lower ROICs. So basically the ROICs in 5 years will look a lot like they do last year. So you can come up with either of those two scenarios. And I can't say they're wrong, but you have to support it with data and sort of logic as the way you put it in your presentation. Final piece is C. And clearly when we looked at the RV chart, ExxonMobil, who you're now talking about, lacks competitive advantage. So you'd have gone back to RV, you'd have gone to your custom spread, and you would have said, given that the industry spread is 1.38 minus 9.74 and Exxon's negative 0.378 minus 8.47, which is a bigger negative spread, then Exxon clearly lacks competitive advantage. And then you could explain why. Like, why are they not lacking competitive advantage today, right? And so essentially they're in a commodity business. They're not truly differentiated. And increasingly, it's not like even at the pump, consumers are, flocking to the Exxon brand to pay more for oil prices, which increasingly are viewed as a commodity. And the end result is that, Exxon is not doing anything really differently than the competitors. And so they're not earning higher rates of return. Now, the question is, in 5 years, if you read through Exxon's annual report, you'll say that they're doing some wonderful things. The question is, do you believe them, right? And so what's going to happen to their competitive advantage over the next 5 years? Do you think the spread's going to get better or worse? That would have been something you talked about in the paper, right? My personal opinion is Exxon probably will relatively improve to closer to the industry average spread and not be a below average company longer term. Okay. Number one, there is the concept of regression of the mean. And two, Exxon is actually considered to have one of the better leadership teams in the world. And I think they actually have well-positioned strategic assets around the world. So as economies tend to improve, I actually do think that Exxon is going to improve its performance relative to its peers and get back to at least an industry average spread over the next 5 years. Okay. So again, you might have a differing opinion, but that's what you'd be talking about. That would have been homework 2. Questions about homework 2? Right. Then you would have moved on to homework 3, and we would have talked about Kroger. So back to the button here. So we talked about Kroger, grocery store chain. Again, start out with a minimum, RV. And this, I told you, use North American Food Retail Analyst Curated. Again, notice if you go to best fit, whole firm, you'll see that they're just in one segment. Okay, so this one, they're just grocery stores, right? So they wouldn't have been any different. But if you, this is the list I told you to use, right? And essentially you'd have gone first to markets beta. And the first thing you notice is the beta in this industry is extraordinarily low. The raw beta for the industry is 0.04. Kroger is essentially close to 0 at 0.01. Right? So that's the point. These companies almost seem to be impervious to the changes in economic conditions. Their beta is close to 0. Right? And it doesn't matter. Good times, bad times, people just go to the grocery stores. Or like a clock. Right? Remember, that's the point. In the pandemic, we didn't stop shopping. We went to the grocery stores. We couldn't go to the physical grocery stores. We did online delivery from the grocery stores, right? And same thing, in boom times, we still go to the grocery stores, right? People eat and they go to grocery stores consistently. So these industries are somewhat recession proof. And most of these industries are lower price grocery stores. Now there is some competition they're facing, which we'll talk about in a second. But nonetheless, so because they tend to be lower prices, and these are essentially goods that are critical to people, these companies tend to not really be cyclical, right? So that's the first thing that we would notice when we did our EIC, right? So the E analysis doesn't matter as much to the grocery stores because that's not really going to affect their performance, right? Now, it will have some impact just in terms of when we start talking about supplier power and customer power because of the impact of inflation that is probably starting to permeate through the grocery store industry, but it wouldn't have affected the, which is the first thing you said. Then if I came over here to custom and I go to spread, I would look at spread of the industry, which this is an attractive industry, right? 6.98 minus 4.32 is an attractive industry. So that's the first thing I want to get out of the way. This is an attractive industry, right? And if you take 6.98 minus 4.32, 6.53 minus 3.51, Kroger has a slight competitive advantage, right? So those are the first two things that you would notice in looking at this industry, is that the industry is attractive. It does create value as much as some other industries, but it does at fairly low risk with a cost of capital of 4%. And Kroger creates slight competitive advantage compared to their peers. Why is this attractive industry? Well, start with the supply chain. And you're going to see, first of all, they don't have a lot of customers over here because it's mostly people like me and you, right? So there's lots and lots of customers, don't have concentrated customers. That does tend to favor the grocery store industry. Now over here, some of their suppliers are pretty important to them. So for example, Nestle, Procter & Gamble, Pepsi, Tyson's. So there is more concentration of some of the suppliers. And when you go through the five forces, suppliers have one other advantage, right? So what the grocery stores do is they control the shelf space. And if you're not on their shelf, it's harder to make money. And so in a way, because grocery stores are essentially very low margin businesses, they do like suppliers that you buy with frequency at better prices because it's kind of win-win. So for example, when you buy expensive Gillette razors, or if you buy Kellogg cereal that are higher prices, basically they make a little bit more money. As a matter of fact, you want to see where they're making money in a grocery store, look at how much shelf space it has. If it has a lot of shelf space, there's a reason for it, because there's limited shelf space. They make low margins. They're not going to put terribly selling low margin products in giant amounts of shelf space, because they're going to look for items that make them money. And so to some degree, historically, it's been win-win with the suppliers that, for example, look at, paper towels or toilet paper or the cereal aisle and how much shelf space that gets, right? Because that's been big money makers for the industry. And so it's also been fairly high prices for some of the food companies. And so the suppliers have not exhibited a lot of power to the grocery stores because in a way they're in partnership with the grocery stores. And the grocery stores have had some power over these suppliers by controlling the shelf space. And that dynamic has started to change. And that would have been something else you talked about in your five forces, as you saw with the rise of non-labeled, generic, for lack of a better word, products. Because the grocery stores, which had this cozy relationship with suppliers, were giving pretty high margin suppliers, and they realized at slightly lower prices for these private label brands, they could make even more money. So that's why you're actually seeing the rise of private labeling. And it's actually frustrating some of their suppliers, right? So that's actually a dynamic that you should be talking about in the five forces, and you could probably call that a substitute, right? Because in a way, the substitutes, which are the brands, the off brands, so I get generic cornflakes as opposed to Kellogg cornflakes or generic frosted flakes versus whatever they call them, versus frosted flakes, then essentially that is a substitute that actually impacts the industry and is starting to become more favorable to companies like Kroger, right, with their own private brands. And when you go through the five forces, as I said, you've probably done the same thing. To get some additional insight into what I'm talking about, you'd have gone to the supermarkets report. Zoom, forget where I am for a second. Zoom, share screen, supermarkets report. And a lot of what I'm talking about is right here. Scroll. Okay. In this part of the business. Now, here's the point. Limited assortment stores that primarily sell private label merchandise. So that's bullet right here in the 10 I've been talking about. You saw increased demand for industry products. Competitive landscape has changed. So there are less barriers to entry in this marketplace than there are to the traditional oil and gas industry, right? And You're also seeing the rise of, for example, convenience stores, companies like 7-Eleven, Wawa, all right, which and to some degree CVS, Walgreens, which are competing to some degree with some of these grocery stores as convenient ways to buy products you otherwise would have gone to grocery stores. You're also seeing the rise of home delivery, right? So whether it's, Amazon Prime and Whole Foods delivery, Walmart Plus, DoorDash, et cetera, and to some degree that some of the grocery stores are partnering with these companies, but even so, they are taking a big margin off of the grocery store companies themselves, which is why they're starting to see fees being tacked on. But the point is you are seeing more substitutes, and that is tending to impact industry profitability. You are also seeing more rivalry as the grocery stores fight for a pie that they're trying to be competitive in compared to all these marketplaces. So that's kind of kept a lid on prices and margins historically, right? We're also, and that's why I mentioned inflation, seeing food prices rise dramatically. Cost of meat, cost of milk, cost of packaged goods, that is rising because of the global supply crunch we're having and the fact that those costs are being passed on by the suppliers to the grocery stores, which are essentially having to pass it on to you. And are they passing on 100% of those costs? So those supply chain costs are rising right now, and that is tending to hurt the grocery store industry. So, and that's showing that the suppliers are actually starting to exhibit a little bit more power today over the industry, which again is putting some pressure on the returns. Question is, what's going to happen in 5 years? Again, just like Exxon, you get a couple of different scenarios. If we normalize in a post-COVID world and consumer demand tends to basically stay high, but inflation returns to more normal levels, that might be more favorable to the grocery store industry. If inflation remains persistently stubborn over the next few years, that might be more unfavorable to the grocery store industry. So you can come up with a couple of different scenarios as to what you think the future 5 forces could be. But again, same ideas, you'd have to talk that in their paper. Final point, Kroger having competitive advantage. I already talked about the spreads between the two. Why does Kroger have a competitive advantage? Again, you could have gone through the BICO and the company reports to talk about this. But one of the things is Kroger is a national brand with national size and scale, and that tends to make them a little bit lower cost than some of the more regional grocery stores. And that's why they probably have a slightly higher spread than their peers. And nothing is going to change about that in the next 5 years. So Kroger will probably still have a slight competitive advantage over the industry in 5 years, right? So that's homework 2. Homework 3, again, questions about any of this? All right, well, today's session was recorded. I gave you some very explicit instructions on what you need to do with Nokia. For the rest of this class, I'm going to give you time to continue working with your groups and make sure you submit your presentation early Monday morning. And I look forward to hearing from each team. Have a good week.
Hi, Professor.
You'll be presenting over Zoom.
Hi, Professor. I had a question. Are we only submitting the PowerPoint, or do you also want us to submit screenshots?
The screenshot should be in the PowerPoint.
Okay, so the only thing that we need to submit is a PowerPoint.
With the screenshots in it, absolutely.
Yeah.
Yes.
Okay, thank you.
Yep.